Okay, welcome everyone. This is just a short video to show how to calculate your break-even point. Calculating break-even point is something that I think most business owners, all business owners should know. First of all, you need to understand your profit and loss and the different elements of it. So your profit and loss will have a sales figure, the value of everything you sell, and then you'll have a cost of sales figure. The cost of sales figure, or the cost of goods sold, is the cost of everything that you're selling. So if you've no sales, you'll have no cost of sales. And if you have sales, you should have cost of sales. So if we take a simple convenience store that sells liters of milk, if the shop sells a liter of milk this evening, it's going to have to buy that liter of milk in order to be able to sell it. So the cost of sale for a liter of milk will be the cost to buy a liter of milk for the shop. And if tomorrow it doesn't sell any milk, its cost of sales will be zero because it hasn't sold any milk. So you take your sales and subtract the cost of sales, and that leaves you with a gross margin. And that gross margin is available to pay your overheads and then to leave you with some profit, hopefully. Now, if we look at the costs that are listed there below the gross profit, marketing, rent, wages, utilities, professional fees, and so on, we look on them as overheads. They're costs that the business has, and they don't vary too much for the different levels of sales. So if the convenience store opens up tomorrow and doesn't make any sales, it'll still have to pay the rent maybe for the shop, it'll have to pay the wages of the server behind the counter, it'll have to pay the heat and light and so on. So overheads are those costs that basically hang over the head, if you like, of the business owner, and they don't vary so much with the level of activity. So just looking at that profit and loss again, we try and understand what's happening. So we see there that we've sales of 400,000 and we've cost of sales of 160,000. So our cost of sales are about 40%. 40% of 400,000 is 160,000. And that means that our gross margin is about 240,000, which is 60%. So we want the gross profit to be the same as the overheads. That's what our break even is going to be. So for every euro of a sale we make, 40% of that, 40 cents, is going to be cost of sales, and that leaves 60 cents available to pay the overheads. So we look at our overheads, we divide them by 0.6, and that will tell us the amount of sales we need to make to generate that amount of gross profit. So, and we can just do that calculation there. So if we take our 201,400 and divide it by 0.6, we're going to get 335,667. And in our case, that's the break-even point for this particular business. We can test that by just slotting the figure back into the model. So if we put in 335,667 and we take 40% of that as our cost of sales, that's going to be 134,267. When we take that 134 away from the 335, we're left with 201,400. That's the exact same figure as the overheads we've got down below. So when our gross profit is equal to our total overheads, that's our break-even point. So again, for every 60 cents of gross profit, we're going to have €1 of sales. So we divide our overheads by the 60 cents to determine the amount of sales we need. So to calculate your break-even, you need to know your overhead in the first place, and you'd need to have a budget or some form of projections to do that. You also need to understand the relationship between your sales and your cost of sales. What percentage of your sales is your cost of sales? It was 40% for us. That means we've got 60% left over as gross margin. So you divide your overheads in euro by the gross margin percentage, or by 0.6, and that's going to give you the answer that you need for sales. So I hope this short video was helpful to you. A couple of things to watch out for. You need to have a good understanding of your overheads. So you need to have a reasonable understanding of the cost of your business. You need to have a reasonable understanding of the gross margin. Depending on the business you have, if you have a mix of different products with different gross margins, depending on how much of each product you have, the overall gross margin will vary. So this isn't an exact science, but what you're trying to do is develop a good understanding of the business. And when you try to do this the first day, and then go back and look at what actually happened and try and understand how that differed from what you expected to happen, That's when you're going to start learning more and more about the business. And that's how you develop your understanding of the costs and how the business is going to behave. So if you like that article or this little video, I have a couple of other articles, related articles that may be helpful. I've one article, The Nuts and Bolts of Accounting. It's actually the first of three. So if you search for the nuts and bolts of accounting, you may be interested in that. I've an article in the blog about how to prepare financial projections. And I've got an article about predicting business costs. One thing I often hear business owners talk about is understanding how much it costs to open their doors. So that particular article is just focusing on that, related to prediction the financial, or it's related to preparing financial projections, but just really focus on answering the question that I find a lot of business owners ask, which is, how much does it cost to open your doors? So that's it. My contact details are on the website, but just again, it's Jim Cahill here from Accounts Plus. My email is jim@accountsplus.ie, and my mobile is 086 23 23 525. So I hope you enjoyed this short video, and thanks for watching.